Hello and welcome to this edition of Macro and Markets. For some time now, the signs of economic slowdown was getting entrenched. This is confirmed not only by official statistics, but we have created a data dashboard of 36 key indicators of the new and the emerging segment of the economy, particularly in the service sector. And we see that the number of indicators that were ruling below their average level has gone up to 65% from 17% by the end of December 2017. We have also aggregated these indicators into one single index, which we call ACAI Composite Indicator Index, which has also taken a steep downturn from April of this year onwards. Clearly, something needed to be done about the economy. The series of measures announced by the Finance Minister, particularly the September 20th measure, addresses these concerns. The headline measure was, of course, the reduction in the effective tax rate to 25% from 35% earlier, as a result of which the corporate profit will get a shot up. As per our estimate, the various indices level 6 to 7% jump in profit is expected, be it NSE Nifty 50 or BSE Sensex, BSE 100 or BSE 500. However, this is also a reform measure as much as it is a stimulus measure, because it signifies effective implementation of the direct tax code, the overwhelming philosophy of which is to have lower tax rates but ensure full implementation by offering no exemption. Therefore, the corporates have a choice to migrate to either the new regime or stay back in the old, and the exact magnitude of the fiscal stimulus will vary between rupees 400 billion to almost 1 trillion, depending upon the adaptability of the corporates to the new measure. Apart from the direct impact of a profit growth, there will be second order and third order benefit of the measure, but it will be diffused. We expect that the prices of certain items might go down, and some part of the benefit might be passed on to the consumers as part of this measure. Some part of it may be returned back to the shareholders in the form of either a dividend payback or buyback. And a part of it might also be retained within the corporates themselves, and that will help them accelerate the balance sheet restructuring which is already undergoing. So, it all depends upon the state of the corporate health and the competitive dynamics of the sector in which it operates. We do not expect an immediate impact on the consumption or investment right away. However, if the equity market revaluation is sustained, there will be an wealth effect on consumption of this, although with a lag. A more significant measure from the medium term standpoint was reduction in the corporate tax rate for the new manufacturing units to 15%. This directly puts India as one of the lowest tax regime amongst its competitive peers in the South Asia. This is the most significant measure towards the direction of Make in India campaign that has happened so far. Overall, the direction of the measures are essentially to help the economy out of the slowdown, and we have seen the government's responsiveness, its consultative approach and the frequent measure with which it is addressing these concerns. Therefore, we have revised our asset allocation call to overweight equity. We have retained our overweight fixed income stance, as we feel that back-to-back measures from the RBI will contain the impact on bond yield, although fiscal concerns might keep the bond yield somewhat volatile for some time. For the time being, we are underweight on the other two asset classes, namely the absolute return strategies and cash. Thank you.